Good morning, everybody. Welcome back to day 2 of the IGB Affiliate London Conference, Electric Avenue stand. We're going to get kicked off today with our first panel session, talking about mergers and acquisition in the industry. And our moderator will be David Levy from XL Media. Thank you.
Hi, everyone. Thanks so much for coming out at 11. I know that's relatively early for second day. Right, I wanted to get started. How many people here are actually affiliates? Okay, and do you guys have like a large percentage of your business in Europe? Yeah? Do you think that now is a good time to sell your business or a business in Europe? Not yours particularly, but sort of from a macro perspective, this is a good environment for a seller in Europe? Show of hands, yes. So no. So that's, I think, how I sort of wanted to kick it off. Why do we think it's a bad idea right now to be selling in Europe? Why is the market a bit bearish? Who wants to start?
I'll start.
Can you introduce yourself? Can we
sure.
do that at the same
Ben
time?
Robinson, director and co-founder of RB Capital. We've been behind some of the most significant transactions in the affiliate sector and also in gaming more broadly. We also manage a fund in Malta that specifically targets gaming companies and those who are touching on the peripheral. So in answer to that question, David, I think that sheer supply-demand forces, pure basic economic principles, would suggest that there is no longer a big elephant in the room just snapping everything up. So we track transactional data and have done over the past 5 years, and analyzing and looking at those stats. In 2017 and 2018, there were over 50 affiliate transactions made public, so there were probably quite a few more that weren't. In 2019, there were 9. So to put that into perspective, Gitana made up 20 of those 50 in 17 and 18. And clearly they're not buying any more because of, well, their share price, bond repayments, earn-out payments due. I'm not suggesting you should short them, but maybe, yeah, anyway. Next question.
Russell, you want to?
Sure. Well, hi, good morning, everyone. I'm a director and economist. I have the pleasure of leading the gambling efforts then for KPMG out in Malta. I guess my 30-second elevator pitch is that I'm charged with trying to have a pulse of the industry in order to anticipate the industry externalities and provide insight on commercial strategy to both KPMG and our clientele across the board. I think your question, Dave, is what we're certainly seeing from a bird's eye standpoint is that margins are shrinking significantly as a result of course, regulation, whether you're looking at player protection, advertising restrictions, credit card bans, whatever it may be, which is certainly meaning that there's less room for lack of a better word, let's say cowboys. You need to have more of an optimized, sophisticated process when it comes down to building up your business. And if you're planning on having an exit, you need to really think about a few criteria as to what it is that you want to be showcasing and selling to the buyer, because the buyer is going to be looking at specific aspects, risk obviously being a key thing. So you can't just be selling the dream, you need to be showcasing then tangible returns that's going to be generating a revenue for the next 3 to 5 years then for any buyer.
Hi, Michal Kopec. I'm a director of M&A at Better Collective. So I think what Ben referred to in 2019, we did a few of those deals. And from our perspective, obviously there was more acquisitions, and that's the fact. And it was a very seller-friendly market a few years ago. I think now things change a bit, but it doesn't mean that it's a bad idea to sell or to consider selling. It's all about the small details, where your company is, what markets you do, what traffic sources you have, and so on. So it's still definitely an option. So that is still doable.
Okay, so maybe I'll do a couple of follow-ups on that. I'll start with you, Michal. So, Better Collective actually just raised $30 million for future M&A activities. I know it's probably something you can't just your strategy share with the whole group, but like in terms of where you see that being allocated, can you say anything about that in terms of U.S. versus Europe, or anything in general about
Yes,
that money?
so obviously history of Better Collective was to grow organically. Then we did the IPO almost 2 years ago, and that was the main purpose of that was funding further acquisitions, and on that's an ongoing strategy that we have. Obviously, we've made 2 acquisitions in the U.S. Last year, pretty significant acquisitions for us, and obviously everyone knows and the U.S. market, and everyone is very much excited about the U.S. market, but it's there's also many other markets in the world. So for us, the first point is to work in the regulated markets across the globe. So that's our strategy really. And if that will be US or if that will be Europe or somewhere else, then let's see about that.
Okay. Actually, can you speak a bit to the 2 acquisitions? I find them personally, like, I think you guys wrote the story from the affiliate acquisition side for the most part in 2019. Very interesting acquisitions, very different too. Maybe you could talk a little bit about strategy or what the thinking was behind both Roto Grinders and Vegas Insider, because they're very different considerations, and it speaks a lot into terms of the types of acquisitions that can currently be done in the U.S.
So I think when you consider US, obviously everyone is considering the potential, because the market is not there yet. You have regulated New Jersey market, which is significant, but when you look at the whole country, it's about the potential. It's not about the existing revenues for everyone in this industry really. So for us, obviously US is a very important market. We wanted to be present there, and through those 2 acquisitions, we've achieved that target. So with the Roto Grinders, it's obviously a daily fantasy product mostly, and that obviously helped us to reach to the audience already with the legal audience on the daily fantasy product, which is connected to sports betting. So potentially with the new markets opening, we already have existing websites, we already have traffic, so that's what's exciting for us. And Vegas Insider, again, it's a big website that people know in the US. There's a lot of traffic, so we are now in the position to be ready for new states to open up, and we'll be there to deliver traffic to our partners.
Okay. Ben, so you actually focused when we talked about the European market on the demand side and said that a lot of people are still in earnout periods. What about on sort of the markets themselves in terms of new regulatory aspects that are maybe complicating valuations and injecting uncertainty? And how do you see that affecting valuations going forward?
Well, I think it's a broader conversation than just the affiliate sector. When we look at the gaming industry across all the territories, and we look at public companies, and the rhetoric that goes on in these public displays of their meetings, they're talking about grey markets. They're no longer saying we have 50% white market, and they're saying we've got 60% grey market, and they're bragging about that. And I think that's quite interesting, because clearly shareholders are more interested in the grey markets now than they were in the blue chips. I mean, UK market, we all know the turbulence that is happening, and some could call it over-regulation. I think it's a little bit deeper than that. You look at Germany's imposition of the £1,000 maximum deposit. I don't necessarily think it's a bad thing to push the industry towards a more casual, sustainable player. But whilst €1,000 might be an acceptable level for one person, it's way too much for a vast majority of the population. So I think whilst the regulation should be looking at imposing protection of players, it needs to be more specific. It needs to be means testing. Sorry, I've kind of gone off track there, but I think the regulatory forces at play at the moment are a big factor when it comes to valuation. If there is any uncertainty in a market, then the asset facing that market, the multiple which a purchaser will pay for that is diminished considerably. And even we were selling affiliate businesses for double-digit EBITDA multiple in 2017. Same business today, half. So it has gone up and then it's come crashing down. But the one thing about M&A is that it's cyclical. You will have a wave and it will go down and it's going to come back up. As a prediction as to when it's going to come back up, depends on how long it takes for the regulatory forces to stabilise. I think 2022 things could pick up in the UK and some of the other, Sweden. See what happens in Germany. But, yeah.
And how do you think these additional regulatory hurdles, does this have the potential to really push forward consolidation if we're going back to the title of the...
It does. Russell asked me just earlier what we're finding is happening in the affiliate space and the types of businesses that are being sold, and we're representing some of the largest affiliates in this space who are looking at exits, super affiliates who are looking at potential mergers, or private equity companies are even looking at their businesses, obviously looking to potentially repurpose that in the States. And then at the other end of the scale, you've just got these much smaller affiliates who are sub-million EBITDA, who are being snapped up by this new breed of, I guess you could say, a middle-tier affiliate who have seen the success of Better Collective and Catena and Excel, and they're trying to replicate that, but they're doing it at a much smaller base, and they're doing it at much more sensible multiples. Mm-hmm. So I think in the next 2-3 years, some of these middle-tier guys will be challenging you guys. And that's, again, just M&A, shifting sands and all that.
So on the same point, Russell, so you're head of gaming at KPMG. You obviously have a very unique perspective on this. What can you tell affiliates in terms of, from your sort of vantage point, tailwinds, headwinds, trend? What should they be doing to sort of prepare themselves for that next round of M&A activity? What changes should they be making? And in terms of risk assessment, how do they sort of approach that?
Sure. Okay. Firstly, I guess it's worth pointing out I used to be an affiliate once upon a time. So it's been interesting seeing how things have evolved. And we've touched upon things. You even touched upon the affordability aspect then as well. I mean, it's the complexities of compliance, as we tend to coin it. And we work with an array of different affiliates. I think it's similar then to what Ben was saying as well when it comes down to smaller and then some of the big boys. Certainly when we look at Europe's tightening up then, and when we look at other grey markets, then that's attractive then to some extent, but there's an element of uncertainty, which from a buyer's perspective casts some element of doubt and would impact then a multiple like that. The US is, of course, the territory that is assumed to be the big daddy. Of course, not just yet, but we're estimating that that's probably going to be about 18 to 36 months away, where it starts to become more commercially viable. Just to hone in on your question, so what we normally see is it took down some pointers as to what we normally talk an affiliate through, particularly when we're looking more of a smaller to mid-tier affiliate who's been in the business, managed to stay in the business, grown it, and is now being impacted by various changes, externalities, etc. So the first thing is, of course, you have to understand what the buyer is specifically looking at. It's looking for the sustainable revenue. So you need to understand what it is that you're selling. You need to try and shift away from any sentimental value, any investment that you may have put in the past, and not try to have that impact then the actual multiple when it comes down to selling. Remember, the buyer is not going to carry the same sentimental value that you have in your business. You want to be minimizing your risk, as you're minimizing risk, the more risk you have, even if there's a massive potential in the likes of, let's say, India, what would happen in India? How is that going to potentially have a downturn on what you're hoping to sell? You have to understand the different sales cycles, the stages that your buyers are potentially at. They could be post-integration, they could have used up all their budget, they could be trying to grow organically. How are you going to strategically fit within their appetite to help them grow? You need to be well prepared before the process. We see it time and time again, of my colleague as well at the back. We've seen affiliates who are very good at what they do, but the industry has matured, and the thought process that needs to go into, even when it comes down to pitching your business, needs to evolve. It can no longer be light touch when you're dealing with the likes of Excel and Better Collective or Catena. You've got people who've got an eye for the business, so they're expecting you to come up and shine on top. If you don't shine on top, if you're not prepared, they'll find ways and means of being able to lower that price. At least I think that's a fair point to say. The red flags, so don't underestimate the tech, the legal side of things. It supports confidence. There's the marketing aspect, how you're really creating. Of course, I remember back in my day, we were looking at a lot of black hat marketing versus the white hat, whether you're dealing with PPC campaigns versus sophisticated SEO measures. You need to understand then the contracts that you've got with each of your brands. Whether you're looking at the CPA versus the rev share, termination clause is absolutely key. Do you own your assets, or are you just subcontracting it out to someone else? That plays another pivotal role. Is anyone cloning or harvesting then your data? What is your infrastructure? You need to look at your risks then. Are you threats of cyber, GDPR, of course? That's one of the key things that we've seen primarily out in Europe, how that could impact then your business. Do you have your audience's consent to be reaching out to them? That also impacts then your bottom line in terms of a multiple. Your post-sale integration, because it's great to be talking about all of these things, but if you've got an earn-out, we've seen it before, where let's say a person may lose control of some of the key people. So if they've got an earn-out for 2 years and they don't have that control to be able to keep those people in check, then you're risking your earn-out potential then over there. And I think the last point is just on the sales document. I mean, that's when you're coming down and you're actually going to be going through each and every aspect. And before you reach that point, it makes sense to be going through all of these other points that we've just mentioned to make sure that you are geared up to be able to get the best value for your business at any given time. Yeah.
Ben, do you want to add anything? I mean, you've been involved in a good number of these European acquisitions. What can affiliates do now to make sure that they're ready to sell when the time comes?
Okay, I think I concur that preparation of your business is very important, and I think most affiliates understand that the higher risk they have on their SEO profiles, the less valuable their business is when it comes to selling. If there's a question mark over the sustainability of the traffic that you're acquiring, then it's a consideration. I think we look at businesses that are looking at various different acquisition channels, and I think that question really is dependent upon which acquisition channel we're talking about. If it's a PPC, media buying, SEO, I think diversification is what people should really be looking at. And if they're completely an SEO shop, and that's their skill set, do it well, and don't leave yourself open to risk. If you're a PPC shop, look into media buying. Market diversification is just as, if not more important. If you are solely reliant on one market, i.e. the last 2 affiliates we've sold were UK focused, and that was pretty much it. And when the UK market kind of fell out, their expectations had to be lowered considerably. If they had a focus on Canada or New Zealand and other grey markets, I'm not talking about the US or Australia, grey markets, that would have bolstered their purchase price. They would have received a larger multiple. Even though the UK is still one of the largest markets globally, the volatility and the media have pushed buyers to a position where they're just like, whoa, no, we want Japan and we want India, we want these markets that everyone's talking about. By the way, if you do have India, Japan markets, come and speak to me after.
I think just to comment a bit on what Ben said about the multiples and the acquisition waves, I don't quite agree with that. My view is that those companies that were doing those acquisitions in 2 or 3 years ago with high multiples that you mentioned, in my view, it might be the case that they basically maybe overspent or paid too much on those acquisitions, and then after doing the earnouts, doing the process, getting along with those companies, they now realize that those multiples weren't basically valid, and they are willing to acquire further companies, but on the lower multiples, because they see that that's how it is, and I cannot see really that that's gonna come back to very high multiples in most cases.
Look, I think, we've never sold to Better Collective because they've never come in first place.
We still do quite okay.
And I fully respect, and I think your company is fantastic. I mean, you're the only ones who have weathered the storm. So from a buy side perspective, I get it. From a sell side perspective, don't know how many of you are from England here. All right. So the analogy I'm going to use here is probably not that powerful. Foxtons is an estate agency in this country, and they charge ridiculous amounts of money, but they push the prices up of the properties to the point where you would only sell with them, you wouldn't buy off them. So I think that's one point to say, and yeah.
To come back to that a bit, the multiples seem very different actually right now in Europe and in the US. And so why is that? Is there something different about the market, Michal, that makes it okay to pay a higher multiple now in the US than Europe? Or is it, because it's also a bit speculative?
I'd say the multiples, they obviously they depend to some extent on the market and the fact that US, everything is big in the US, so multiples are big as well. So. But at the end, it comes down to what you need to what your company wants to do, what your company wants to acquire and where, and if that makes sense. And at the end, it's the money that you need to pay and the business that you're looking at. And if you like that business, then yes, you potentially can pay a bit more in Europe. But that doesn't mean that you won't find companies in Europe where you will be willing to pay a bit more for them if you see the strategic fit in Europe.
If I may, I think one of the things that we've been learning, we've been investing a lot within the States. And if we look at the States in terms of channelization from a regulatory standpoint, very different to the way in which we've seen it being done out in Europe. We pull out one of the key things. Europe, what's close to their heart, you look at player protection, responsible gambling, etc. From a US standpoint, what we keep on seeing is criminal probity. They want to eradicate any form of criminal activity. If we look at Europe and we see the steady rise of the industry and now the maturity, there was a lot of money, big margins to be made. I'm quite vocal about this. I believe that there was a lack of self-regulation, which has cornered the industry in a sense. It always seems to be gambling seems to be the industry that is first to be hit, politically wise. So I think when we look at the US, beyond that of it's like a burger, you grab a burger in the US, it's going to be far bigger than that of a European burger. But I think part of the hope that I have is I don't necessarily see Europe going back and starting to loosen certain measures, especially when we look at the likes of the UKGC, the Swedish Gambling Authority, Italy on the advertising restrictions, etc. But my hope is that perhaps the US will be able to roll it out, learn from Europe. Hopefully the operators would have also learned from what happened in Europe, inflict itself with an element of self-regulation, and perhaps down the line, then the US will be able to come up with certain measures that are more attractive than Europe, and perhaps, once again I caveat it, perhaps Europe will look at it down the line and say, okay, the US is managing to keep all of this in check. Perhaps we can consider to start to keep things a little bit broader, broaden some of those restrictions. I think only at that point. So I think at this point, US remains the big daddy, and it's very hard to be making money at this point. But I think for those that are willing to play the long game, and I think that's the difference now. You can't be wearing your short-term goggles. It needs to be your medium goggles, at the very least. Long-term goggles are what's going to separate then the big boys from the smaller.
Yeah, I think the only reason multiples are high in the States is potential. That's it. It's the future potential of the market, and nobody's really making huge amounts of money in the States right now, but the market is going to take off, and the multiples are reflective of that.
Okay. I wanted to, we have, I think, 5 minutes left. Is there any questions from you guys? Ron?
Great panel, thank you. We were talking about giant American hamburgers and big daddies and medium-term goggles and the giant multiples that we should expect for US affiliate sites. Can I get your thoughts on multiple ranges?
I think that I just don't think you can look at a business in the States and say, okay, you're going to give it a 5x, 6x. On what? What are you giving it a 5 or a 6x on? Right. When we enter into a transaction, we make sure that the sellers are expecting a wide range of structures that value their business. And I think if you're selling your business in the States right now, I would not be requesting a 12-month historical revenue or EBITDA and multiply that by anything, because you're just leaving money on the table. The potential is 2 years down the line. So any deal that you have should be a forward-looking multiplier on the future of the revenues that you're making, or the EBITDA.
What have you seen in terms of historical lows and highs, just so we can have a bracket? What's your experience around that?
Sorry, on multiples of...
Yes.
Again, the question is are you asking whether it's a historical revenue based on the last 12 months?
No, I mean on actual M&A that we've seen in the market recently. What's the lowest multiple you've seen and the highest multiple you've seen?
In the States?
Yeah.
A lot of these have not been publicly made. I mean, I think if you pose that question to Michal, maybe he'll divulge that. I don't think so.
I think it again. It's if classically you would be looking at the EBITDA multiples that Ben mentioned, and for us it's as well US it is a bit different story, and you cannot be looking only on that at that, but at the same time it's about the potential. It's about the synergies you have with the business. In our case, with Europe. And I think a lot of affiliates in the US are expecting 10, 20 times multiples, and that's not going to happen, in my view.
Disagree.
And yeah, for us, it's basically not going to happen with those prices. But yeah, someone might be able to come up and pay those multiples. Again, it's the U.S. market, and let's see what will happen there.
There are so
all
many...
eyes are on the States. Sorry to interrupt. All eyes are on the States, and any of the big guys are plonking themselves there. So the competition is all there, and I will never tell an affiliate, even if they're going on their own, don't go out and ask for a price. It just creates a ceiling. You'll only ever get that price, which is why when we take businesses to a formal sales process, these guys ask me how much. I say, well, it's not for me to decide. We put that out and we present the business in the best possible light, and the process that we run generates the highest possible return.
I think just maybe adding on to that, I mean, linking it back to Europe, I think Baybets was, for instance, one of the key drivers that started to turn a lot of affiliates' heads in that direction, and that was a massive multiple then over there. I think the important thing is one company may be willing to pay far more than another. It depends on the values and the synergies of the business that can come about. That's why it links up then with those points at the beginning. If you've got an exit strategy, you need to be kind of pinpointing who it is that you're going to be approaching. Don't try and take a shotgun approach, who it is and why. I'll give you an example. Once again, linking it back to a European standpoint, since margins are being squeezed, you look at content providers, for instance, who have always had a revenue stream coming in from their content, whether it's royalty fees, rev share, etc. But now they are having to look at various other aspects within their business to try and monetize other areas of the value chain. Affiliation would also be a key area that they have an element of control on, and that could start a new wave of acquisitions if you can gear your business up to be appealing to them, to be valuable. And I think that that's where you would see a content provider may be willing to pay more than, for instance, a Better Collective or an XL Media or a Catena. But it really depends on the circumstances. And the thought that goes into it, I don't think it can be a last-minute impulse sell. It takes years to prime it to get the best value. And you want to avoid that overinflation, where people are just showcasing that they've managed to acquire a company and managed to get an extra 50 people, 100 people, and those 100 people are sitting at their desks, twiddling their thumbs, not doing much. There's a part where it actually starts to burst, you know? So you need to be optimized in everything nowadays.
I would also just say the U.S. is unique. I'm with Ben. It's very hard to put a multiple. If you have an asset that is extremely strong in the U.S. and it's all offshore and you need to, so what are you basing the multiple on? Are you basing it on the multiple of the revenue that was done with offshore, which you immediately need to close down after you do the acquisition so that it can be, it's compliant? Or do you, after you've done that, it's zero. So then, what is it, infinity? So from that perspective, obviously, there are entirely new challenges in the U.S. market. This Penn Barstool deal is amazing. It was an extremely, extremely high valuation. The market loved it. Penn's stock jumped considerably. So I think it is speculative, and that's the nature of the beast. And it very much depends on what's going to happen in the next, 2-3 years to see whether or not people are gambling the right way on it. So, thanks to these guys, and thanks for coming.
Thank you, David.
Thanks, David. Thanks.